Welcome everyone. Welcome to this episode of Market Trap. I have with me Mr. Pankaj Pandey.
And what a week it has been. So we are back to somewhere around 24,850 levels, and not so great news so far. While the results are out, there's still a lot of uncertainty. Lots to unpack in this episode regarding that as well. I think we have got the India EU deal as well, UK deal as well, and then we have updates from. We are still awaiting updates from the US India deal. But let's get to the market outlook first. What is the outlook on market right now, according to you?
Yeah, hi, good evening, Vishu. So again, this is the fourth consecutive week where markets have extended losses. And again, because of two things. One, we don't have clarity on India-US trade deal. The other is the overall earning season is going on fine, except for the fact that it does not have enough sparks to sort of lift the overall market sentiment. And in that process, so we are still in a sort of a consolidation mode. And I think what we have clearly seen is that while Nifty has been sort of extending losses for the fourth consecutive week, even we've seen mid caps and small caps losing 1 and 2% respectively. Sectorally, I think IT is sort of struggling the most. We are seeing maximum selling happening in IT stocks by FIs. And I think Infosys results haven't really helped. While they have upped the guidance from 0 to 3% for this year to 1 to 3%, but it does not really move the needle much because there is not enough clarity on the macroeconomic scenario of US, and which is why spending and other factors are still not sort of able to sort of guide us enough. The other is on the financial side. I think we had some of the numbers coming from Bajaj Finance. Now, Bajaj Finance again is talking of slightly slower growth. So when a company is sort of priced to perfection, this is one stock which delivers 4% ROA, trading at similar four-time book. So when it says that the growth could possibly come down from say 24 to 21 odd percent, it has implications for a lot of stocks, and which is why on Friday we've seen a deep cut in a stock like Bajaj Finance. So IT, real estate, FMCG largely weighed on the markets, and financials again selectively have sort of performed. And our sense is that this kind of a consolidation mode can still sort of go on because we don't have enough clarity, at least not in the next 10, 15 days. I would expect to hear something on the trade front. So which is why supports for the market will now be placed at 24,500. And unless the market does not take out the 25,300 kind of a level, possibly uh, till that time markets are going to sort of stuck in this range. It needs to take out 23,500 for higher levels. So from that perspective, a lot of uncertainty is still sort of clouding the market.
Absolutely. So the India UK free trade agreement deal is the fine prints are out. What do you think about this deal? What is happening here?
So yes, see, while India-UK deal has happened, signing formalities have all been done, but we really do not see much of a cheer in the market. Largely because the UK is a smaller economy compared to US, and which is why you're not seeing that kind of optimism. But having said that, it is definitely positive for some of the sectors. I think textile is one of them because UK is a sort of a decent exporter importer of textiles, about $27 billion odd. And I think India does only 7% of contributes only 7% to those exports. And I think India pays about 8 to 12% kind of a tariff. So going forward, there will be no tariff. So companies like Gokuldas, Indocount, I think should benefit from that aspect. The other is the agricultural goods and commodities. So one highlight here is that ITC does a decent amount of exports. So they are big exporters of spices like chili, turmeric, coriander. So I think ITC could be a beneficiary of that. And again, here, while India does exports of somewhere about $51 billion of agricultural products, but to UK, it's hardly about $1 billion. So from that perspective, I think that can also be a segment which can benefit from this deal. And on the gems and jewelry, again, going forward, there'll be no more 4% duties which the jewelry used to attract. So from that perspective, it could be beneficial for some of the players like Titan. But then again, we need to see if they really venture into that. I think one positive surprise is the footwear as a segment, because up till now, Indian footwear exports to UK were attracting a tariff of about 16 odd percent. And I think so. We were exporting very minimal numbers, about 440 million dollars. From that perspective, the numbers were quite low, and I think this number can go up. So, which is why companies like, say, Mirza International, Metro Brands, or Relaxo could benefit. Again, these are not recommendations, but these are the companies which can be in the limelight for that. And last but not the least, again, liquor, the duties will be reduced from 150% to 70%. And a lot of Indian companies do import bulk quantities in Scotch. And somewhere down the line, I think some bit of a pricing benefit is what they can get. So companies like, say, Allied Blenders, Radico, Khaitan, I think could benefit from that aspect.
Right. And of course, the earning seasons is here. The first few results are out. So far, how happy are you with the results?
So, Vishu, if you sort of look at from the earning side, uh, so out of Nifty 50 odd companies, till yesterday, about 16 companies have come out with their numbers. But by weightage, these 16 companies contribute 51% of the index weight. And again, from an earning perspective, FY25 Nifty earning was 2%. FY26, the expectation is 8%, and followed by about 16% kind of earning growth expectation for FY27. So quarter one, what we have seen is about 6% kind of a top line growth and 8% kind of a bottom line growth. So from that perspective, it is on expected lines. Where we have seen positive surprises against select private sector banks, Bajaj Finance, I already highlighted some disappointment. Then I think commodity pack, especially the likes of, say, cement and steel, I think those are the two segments which have done well. And so from that perspective, there are a few pockets which have done well. And if I sort of go to mid caps, I think mid caps have done even better with a 15% kind of a top line and bottom line growth, and largely to do with the fact that a lot of these smaller PSU banks have witnessed treasury profits because the 10-year yields have declined. So those are getting reflected in the mid cap earnings, so a 15% kind of a growth. And so from that perspective, relatively mid cap earnings are on a slightly brighter side. But having said that, it is still early days to sort of give a concrete picture on the overall results.
Absolutely. Let's get a little sector specific, sir. Let's start with FMCG maybe. I think Tata Consumer and Nestle came out with results. What do you think about them?
One thing I think, Vishu, most of these companies are highlighting is that there is a bit of a margin pressure, and I think the rural recovery is fine. I think the urban market is sort of holding steady, so steady improvement is what they are expecting. But having said that, FMCG companies, given their valuation, so for example, Nestle trades at a forward multiple of 63 times. Now, when a company like this gives a volume of about 3% volume growth and witnesses margin pressure of 250 bips, again, reasons are genuine, because the coffee and cocoa prices have gone up, so that has been sort of impacted the gross margins and EBITDA margins, and which is why the stock has taken a beating. But nevertheless, our sense is that things will improve from here on, because some of these commodity prices have cooled off. The other is that the company has been doing capex, so which is why there is a higher depreciation being charged. So some of these factors are impacting. And again, out of their top 12 brands, 7 brands are growing in double digits. So not everything is lost. But yes, with such expensive valuation, you can't deliver 3% volume growth and expect no price reaction. I think Tata Consumer relatively did better, 6% kind of a volume growth. And I think this company is also sort of witnessing challenges in terms of some of the input prices. Key prices had gone up. Now it is sort of corrected. So this company again witnessed a margin pressure. So overall sense is that this company will deliver double-digit kind of a growth, and earning-wise, the growth is even going to be higher with margin expansion expected. So from that perspective, I think Tata Consumer is a relatively better place. It is valued at about 48, 49 times forward basis as compared to HUL. And HUL also is not doing great in terms of volume growth. So So that way, I think Tata Consumer is doing well. But I think overall FMCG is at best is going to give you a FD kind of a return. Can't expect them to sort of beat market very soon.
Right. The index was happy after HDFC results as well, primarily because the stock itself was around 2% after the results. What did you think about the results?
Vishu, HDFC Bank numbers were steady from that perspective. I think you have overall, when you look at gross NPAs were sort of steady, so no major challenges what we see. But I would want to highlight two, three things why some of these banks are still not really doing the kind of price performance what one would have expected. So we all know that RBI has cut rates by 100 odd bips. So first 50 bips rate cut last quarter we have witnessed. So HDFC Bank in particular have witnessed a margin pressure of 11 bips. Now further 50 bips rate cut will also lead to margin pressure in the second quarter of about 19 bips. So Q2 is also again expected to witness a margin compression. It is from Q3 onwards when the margins will start recovering because you will have CRR benefit and the deposit will get repriced. So my sense is that half of this overall margin pressure being witnessed in first half will be recouped in the second half, and that is when banks are expected to sort of do well. And HDFC Bank is expected to do in line the kind of a credit growth this year and outperform the industry next year. So my sense is that incrementally things will start getting better for HDFC Bank, and whatever weakness we see in the stock is a sort of a buying opportunity, which is why we are maintaining a buy on the stock. But yes, when I said that the sparks are missing, probably the sparks could come in the Q3 onwards, and that is where a big sector like banks is expected to do well. And whatever FI selling we have seen off late, I don't think BFSI is attracting that kind of a selling. In fact, first half of July, we've seen inflows in the bank. So I think HDFC Bank is expected to do well. That is what a view we would want to carry, but not now, but probably a quarter down the line.
Next up, what do you think about the electronic manufacturing sector? Maybe Dixon, and we also had results coming up from Sarma.
I think we should EMS as a space is coming out with a good set of numbers, and we have component manufacturing PLI expected to sort of come up. So overall sense is that this is one area in terms of PLI we are clearly sort of doing a lot better, and this is one of the success stories. And our sense is that this entire space is looking quite good to us for the next 12 to 18 months perspective. Coming to specific results, again, Dixon, if you sort of look at, witnessed a 95% growth YY basis, something similar jump in the EBITDA as also we have seen. So they manufactured nearly about a crore phone in Q1. Expected to do about 4 crore phones this year and about 6.5 crore kind of a phone in FY27. And mind you, bulk of their revenues come from smartphones only. So I think this company is sort of doing very well, and we feel that the growth trajectory of this company is going to be pretty robust. And in fact, we are expecting about 66% kind of a CAGR the profits, and which is why we are valuing it on a higher side at 63 times. So these companies are not cheap, but one cannot take away the fact that these companies are growing at a pretty fast step. And I think something similar in Sirma is also what we have seen. I think this company, their EBITDA is up nearly 93 odd percent. This company is venturing into PCB manufacturing. PCB overall is a $5 billion kind of a market in India. 90% of that is imported. And there is a good chance that this company will look to sort of tap this opportunity. So again, we are liking this company with overall sense that going forward, the growth rate is going to be pretty robust, and which is why we have valued at about 47 times again with a good target price of 825.
Right. You also mentioned you are particularly happy with cement companies. What is happening in there?
So yes, I think cement overall good set of numbers. So if I sort of put a combined picture, for whatever companies have come out with numbers, there is 8% volume growth YY basis. There is a 7% increase in realization. So revenues have grown by 15 odd percent. In general, the EBITDA per ton has gone up by about 300 bips. And overall sense is that going forward, you will have demand CAGR of nearly 7% and supply CAGR at 6 odd percent. which means that the prices are likely to remain steady and even the capacity utilizations are expected to sort of inch up. So from that perspective, cement as a pack looks very good to us, and which is why we are liking the entire UltraTech as a pack, UltraTech, then Dalmia Bharat, Sagar Cement. So these are some of the companies where we have come up with a buy rating. Even JK Cement has come out with good set of numbers, but somewhere down the line, the prices have sort of inched up. So from that perspective, the entire cement as a pack has sort of done well. And our sense is that this sector will continue to do well, at least in this year.
Absolutely. And finally, it's time for the hidden gem of the week, which will be this time.
Again, like I said, Vishu, cement looks good to us. So I am recommending Sagar Cement with a target price of 305. Now, reason for liking Sagar Cement is there are multiple reasons. One is the company has a good amount of debt on the books, so they're looking to monetize 107-acre kind of a land parcel what they have at Vizag, probably in the next 1 year. So they could raise about 350 odd crores. So in that process, they can bring down their debt. And the other factor is that this company is trading at a pretty cheap valuation of about $47, $48. Most of your acquisitions are happening at 70 to 80 or probably $90 EV per ton. So valuations are definitely attractive. Last quarter numbers were quite good. This company witnessed the maximum increase in EBITDA per ton, and they're increasing their capacity marginally, say from 10.5 million to 11.75. And we are expecting their volume growth to be healthy at about 7 odd percent. On top of it, the overall improvement in EBITDA per ton is expected to be about 250 to 300 rupees in the next 2 years. So I think this company has a number of positives. On top of it, our sense is that in Andhra, we will see better demand because Amravati development is going to happen. So this company could also benefit from that aspect as well. So the multiple triggers, we feel the stock should do well. And cement we have been liking in general, so which is why Sagar Cement with a target price of 305.
Absolutely. Well, that was it for this time. Thank you so much, Pankaj sir, for your insights, and thank you so much everyone for watching. If you have any questions, please put them down in the comments, and we'll try to get back to you.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.